Hi, this is Jared Snyder, and I wanted to have a discussion with you today about an issue I'm seeing some of my clients wrestle with, and that's what to do with pension plans. Specifically, whether we're making a decision to take a lump sum payout on a pension plan, or we're deciding to take an annuity stream of income from a pension plan. So if you work for a company that offers a pension and you are a participant in that plan, the pension plan can offer a lump sum payout as an alternative, if you will, to that annuity stream of income that we typically think of with a pension. Usually the way that pensions worked in the past, you were accruing benefits in that pension plan over the years as you were working. And once you retire, at some point, you start getting a monthly paycheck, kind of like Social Security, sort of a supplement to Social Security, if you will. A lot of plans, a lot of defined benefit plans are moving towards offering lump sum payouts rather than having that liability on their books for the company, for the rest of your lifetime, for the rest of the years that those benefits are owed. Companies are able to move that liability, off of their balance sheet by paying out a lump sum. Now, whenever someone takes a lump sum, that doesn't mean it's all taxable in that year. You can do a direct rollover of that lump sum amount to an IRA. So we're really not worried about taxes in this discussion today. We're really just kind of looking at the mathematics and then some of the other reasons why it may make sense to choose one option over another. So again, certainly that trend in defined benefit plans, pension plans, is to offer those lump sum payments. And so when we're analyzing whether it makes sense, if you've gotten a letter from your company that you work for, that you did work for, that says, hey, we'll offer you a lump sum payout on your pension rather than you taking a monthly payment, monthly distribution, and you're trying to decide how to go about that. You need sort of some tools for how to analyze it. And so really the analysis there is driven by a few factors. First off, it's really driven by the interest rates and the mortality tables that the actuarial company that's doing the calculation for what the lump sum offer is using. And what we're seeing in today's environment is that the interest rates that they're using to discount those future cash flows to offer you a lump sum, those interest rates are very low, which makes sense because interest rates here in the US and around the globe are very low. Federal funds rate is at 0 right now. So we've got very, very low interest rates. The rates that actuaries are using to discount those future cash flows to make a lump sum offer to you are very, very low. And our mortality tables are also relevant depending on how far out into the future the actuarial adjustment would assume your life expectancy is. That also comes into play. So that's one factor, the interest rates and mortality tables. Another factor is just kind of your comfort level with what happens if you do take that lump sum payment and if you do roll those dollars into an IRA rather than taking a stream of income. If you do that, you've got to have a comfort level with the variable levels of returns that you would see on that sum of money versus the guaranteed payment that you would receive as an annuity stream of income. But from the math standpoint, or from the growth of wealth standpoint, let's say that if we're seeing interest rates of 2 to 3, maybe 3.5% on the high end being used by actuaries to calculate a lump sum payment, that's generally what I'm seeing whenever I'm analyzing these types of situations for clients. We have to ask ourselves, okay, do I want to accept what is in essence a 2 to 3.5% return for the rest of my life on these dollars? Or do I think that markets can return higher than that? And so, the higher the interest rate that an actuary uses, the more attractive that annuity stream of income becomes. If an actuary is using a 5% discount rate, that's actually kind of attractive. If we're seeing 5%, or we used to see even higher than that, 6, maybe 7% discount rate, then in those instances you have to feel confident that over the remainder of your life, or you and your spouse's life, if you chose a joint and survivor pension benefit, that you would be able to consistently get returns higher than that 5, 6, 7% range, which is, that's a bigger bar to get over. 2 to 3% is a lower bar, so those lower interest rates are really lowering the bar for participants in defined pension plans to say, hey, I think I can do better than that with my money. I think I can grow my money more than 2 to 3% over the next 20, 30 plus years. And if that's the case, a lump sum might actually make sense for you. One other thing to think about whenever you're choosing lump sum or a pension annuity payout and a monthly payout is just, what do you want to have happen with the dollars in the event that something were to happen to you and to your spouse. Whenever you choose a monthly annuity stream, you can, choose, generally pensions will let you choose either a single life benefit, which just means as long as you're alive and you're the pension beneficiary, you get the money. But when you die, the benefits stop. If you choose a joint and survivor benefit, then whoever you name, typically it's going to be your spouse that you name, they would receive some level of benefit in the event that you were to pass away. But once you're both gone, what happens then? If you want assets left to either family, friends, charity, whomever you choose, then a lump sum, might be a really good option for you. So, you need to have a reasonably good level of confidence that markets are going to give us better than whatever the interest rate that's being used to calculate the lump sum offer that you've been made. You also, if you're going to elect the lump sum offer, you need to be comfortable with the burden shifting that's going on, with the shifting of liabilities, because really that's what a lot of this comes down to for the sponsors of these pension plans, the company that you worked for. They want to get this off their books. They don't want to have this long-term obligation over years and years and years. And so they're shifting the burden of that from themselves or to a company that they would help have come in and help manage the pension plan. They're shifting that burden to you. They're saying, hey, here's your lump sum. Go and do whatever you choose to do with it. It's not our concern anymore. So as long as you're comfortable with that shifted burden, and you're comfortable that you can have a great investment plan for those dollars that's going to capture better returns over time than what you're going to get, based on the interest rate that's being applied to give you that lump sum amount, then a lump sum can make a lot of sense. So just feel free to give me a call or email me and let me know if you have questions on this. If you're analyzing a pension right now, maybe you're wrestling with this exact situation and you just want a second set of eyes and a sounding board to help you make a great decision, give me an email or call, and our team is glad to be of service to you. Thanks so much. Have a great day.